Hi, everyone. Happy Wednesday. I just wanted to send an extra message out today because I don't know how many of you follow the financial news, but the Fed increased interest rates today by 25 base points. So I wanted to reach out and say what kind of effect this may be having on the mortgage market, which obviously directly relates to our real estate market. So why is the Fed increasing interest rates? Because of rampant inflation. We all know that it's so expensive going to the grocery store, and everything is exceedingly expensive. And so you're having to spend more money to get the same product that you were getting just a short while ago. So how does this relate to our field? Well, mortgage rates are tied to the treasury yields and the economy. Okay, so the higher rates means that our buyers have less purchasing power, and we can talk about what that looks like and how much of an increase affects how much buying power. But we're speaking in generalities right now. Okay, so what we have done that have caused these higher rates is we've had 4 consecutive increase of 75 base points, followed by an increase of 50 base points. And then today they came out with 25 base points increase. So that's definitely diminishing. So this is reflecting the signs that inflation may be beginning to relax a little bit, but we haven't whipped it. We haven't gotten back to a usually between 2 and 3%. Inflation year over year is what is considered typical. But we're not back to that yet. So a lot of the pundits have been saying that we're likely to see more increases, but it looks like these increases are coming at a smaller clip. Okay, so it may signify the worst of it is over, but we're still having to fight it. So according to Jacob Channel, a senior economist for LendingTree, what does this mean for our buyers? Despite another rate hike from the Fed, mortgage rates could actually remain near where they are over the coming weeks or even continue to trend down slightly. So this is not to set off alarm bells for all of our buyers necessarily. They just need to make sure that they continue to communicate with their loan officers. So the average rate for a 30-year fixed mortgage is currently 6.4%. which is down from a peak in November of just over 7%. Okay, so we're still down a little bit. According to Charlotte Galica, a certified financial planner with Silver Penny Financial in Atlanta, a small rate hike isn't going to move the needle in a huge way. So 70 or 25 base points isn't going to have as much of a reflection in the market as the 4 consecutive 75 base point increases. Okay. But a lot of our buyers need to buy now. We don't want to price them out of their homes. But for some buyers who need to buy, trying to time rates might not be a smart move. It's wiser to make the purchase within your budget now rather than sit and wait for interest rates to fall. So this goes back to the same thing we've been talking about a long time. Marry the house, date the rate, because you can always refinance your rate down the road, getting into the house. And when inflation is continuing to stay high and the price of our homes continues to grow for our buyers, not only are you going to make a higher payment because of interest rates if they're high, you're having to spend more to buy the same house. So it's better to get into the house now with a higher rate and then over time be able to refinance that rate to bring your payment down. All right, so just taking a quick look at the last 3 months, it's been on a downward trend. So you can see back to November that we're where we were at 7% on a 30-year fixed. And that we've been coming down. So we have been on a downward trend, despite the fact inflation has still been a significant factor in the economy. And then those of us who've purchased homes over the course of the last 40 years, this chart's great. This is the 10-year treasury over the last 40 years, and it's been continually coming down. But you can see where it is now versus where it was, 15, 20 years ago, and we're back to that point. When I bought my first house in 2005, my rate was higher than what you can lock in right now. So we just have to help our clients have a little bit of perspective of saying, even though rates feel high, they're comparatively high. they are comparatively low if you go back within our lifetime and take a look at what's going on with the interest rates. And we have a much better handle on our markets now than ever before. All right, so I hope you found a little bit of this useful in coaching some of your buyer clients in case they're starting to hear some scuttlebutt on in the media and on the news, because again, we all know they like to sensationalize everything. But first things that they should be doing is just staying in contact with their loan officer and making sure that they're aware of what their buying power is in case there is a rate increase. But again, what they're saying is that it doesn't look like it's necessarily going to cause an increase and may even go down a little bit. All right, everyone, I hope you found this helpful. Go out there and sell some homes.